Hello everyone, welcome back to Investsphere Wealth Invest Tech series. So today we are going to do what are the mistakes you as an investor is doing in this present market. So let's discuss about how your emotion is driving your investments, which is not right. So first let's talk about the positive side. So today market is all-time high. People are getting 40, 50, even 100% returns in different funds or different stocks. But do you really know, when we are asking to book profit, they say no, it is doing well. Why to get out of it? So that is what emotion is. When you are investing and having some investment strategy, like I will wait for 30% or 40% or 20% or 15%. So please stick to that particular objective. Once you are getting that objective, you should book the profit and get out of the particular strategy. Similarly, in the other way, when market goes down, people used to wait, or people used to take out the money thinking that it may go further down. So both the emotions you need to calculate as per fundamental analysis and technical analysis, so that you can take a quick call, not emotionally but financially, but some informative decisions, some calculations you may do and take a call. The second mistake which we do, or which investors do, are like following the crowd. There are a lot of people I have came across in my life, where people used to talk that my friend has bought these stocks, my relative have bought these stocks, somebody told me to buy this stock, hence I bought. Everybody is buying the stocks, so why not me? Let's jump in and get some good profit. So today, recently, there are a lot of customers are asking funds from defense sector. So we are saying no to it, but they are demanding that defense is doing very well. But trust me, if you're not thinking about your fundamental analysis, if you're not talking about price earning ratio, there are a lot of ratios you should understand as a fundamental analysis. And technically also, if you are okay to follow, then we also suggest to go for a technical analysis also before investing in that particular stock. So it is always advised, it is always good to have good advisors in place, or good distributor in place. Those who have experience, they can guide you properly and you can go ahead. It's like Abhimanyu. When there was a war, he learned how to get in and fight, but he don't know how to get out. Similarly, when you take calls, take a decision based on your friend's suggestion or somebody else's suggestion, or from the crowd, thinking that yes, I'm getting into a good stock, but they may get out of those stocks when they need, but you don't know what is their strategy, so you may not be able to follow, or you are not getting out of the particular stocks. So hence there is 100% chance that you may get into trouble in future. You may get into losses in the same stocks which was doing previously well. So it is always better to talk to your experienced advisor and take the decision. Nowadays, most of the people are forgetting about diversification. That is our third suggestion. So if you see, if you do not diversify your asset classes, when I'm saying, it is between assets. That is, one is, let's say, equity, the other one is debt, the third one is real estate, fourth one is maybe arbitrage, maybe gold and silver, which is into commodity. So diversification doesn't mean that only in equity what are the diversification I have taken. I'm talking about asset class diversification. So you need to diversify between the assets on a right percentage based on the valuations. Similarly, if you talk about equity, then what are the diversification you are doing within equity as an asset class? So if you see equity, then there are 3-4 diversifications, like small cap, mid cap and large cap. In large cap, where top 100 companies are part of the portfolio. In the mid cap, 101 se leke 250 stocks, and then small cap, it is 251 se leke other stocks which is not falling under large and mid cap. Now, what are the percentage you should consider in your portfolio based on your risk appetite? For that, you need to contact us, or for any registered advisors, where you can discuss with them what is your risk appetite, so that they can diversify your asset class. And with the diversification, you can minimize your risk, you can maximize your returns. The fourth mistake again, The fourth mistake is when investor is trying to time the market. Is it really possible? What I understood by talking to a lot of fund managers, a lot of MD and CEO of different asset management companies, that nobody in the market can time the time it, like when to enter, when to exit. So timing the market is not good for your investments. There are histories where you see for the last 30 years, 40 years in investments in the equity market. If you miss 2 to 3 days also, you lose a lot of money. You don't know when market is going to go up and when market is going to go down. It's a pure demand and supply game in the share market. So price is discovered by the demand and supply, not by you, not by anybody who is judging the market or trying to time the market and telling you that he'll earn a lot of money for you because he know how to time the market. So it's a suggestion, again, you should not fall in that fall in that trap. So you follow the fundamentals, you follow again technicals, and you start investing in the equity market. The fifth mistake is not having a clear financial goal. What exactly you want, in how many period, how many years. There are a lot of people, they have not yet planned for their own financial planning for next 5 years, 10 years, 20 years, 30 years. I have been doing this for the last 1.5 years. This activities, every customer I meet, every investor I meet who is younger in age, they do not have a clear picture what to do, what not to do, how much to save, for what are the reasons. So the point is, if you do not know how many years or how much money you want to create over a period of time, then you are doing again mistake. So hence it's a suggestion to make a good plan, solid plan, and you give a time duration to achieve those plans, then only your investment will be successful. If let's suppose if I have planned my retirement plan, I have then 20 years. So in 20 years, if I want to accumulate a simple amount of, let's say, 3 crores, so that I can get good amount up to 60, then today you have to do an investment of only 10,000 rupees, and if that grows by 20%, then you'll get 3 crore. And if it is growing by 15%, then that same 10,000 rupees is going to give you 1.5 crore over a period of 20 years. So hence planning is important, your visualization is important for next 20 years, and then the investment of 10,000 is going to suffice your requirement. The sixth mistake is ignoring the cost. There are a lot of cost involved in your investments. So you need to understand all the cost of your investment options on investment plans. Let's say talking about insurance plan, where the investment, the cost of that particular product is very high. Hence your returns will be definitely very low as compared to the mutual fund industry. Now let's talk about your future options or derivatives or any other products you are trading into. Or you are buying a real estate, what are the costs involved? What are the taxes? After sales, what are the net income post tax? You need to consider all these points in your mind. So let's say if you talk about mutual fund, probably if you compare with all the products, mutual fund maybe will be a best product in terms of cost effective instruments to invest for. So never forget to analyze the cost factor of your investments. Thank you so much for watching this video, and stay tuned with Investsphere X series. We'll come up with more and more informative videos which will definitely help you to earn money in equity market and be informed. The most important is be informed before you invest. Thank you so much.